Hello, this is Nate Gable. Today we're going to take a look at example worksheet 8.2, dividing income. In this scenario, we're looking at a partnership with two people. They're looking at establishing a beef cow calf operation, a joint beef cow calf operation. Sam and Allie. Sam owns $40,000 worth of beef cows that he's accumulated over the years. These cows will be depreciable at 10% a year. And if Sam sold these cattle, he could invest this money for a 5% return. Sam has a principal and interest payment of $6,000 per year on these cattle. Allie has 40 acres of pasture and a barn that the cattle will be grazed on and housed in. Allie is currently renting the land and buildings to a neighbor for $4,000 a year. She has a principal and interest payment of $5,000 per year on the land and buildings. She pays real estate taxes of $1,000 a year. Each will contribute the same amount of labor and management, estimated at $5,000 apiece. So all we're going to do here is just simply figure out what each person or partner is contributing to this partnership so that we can then determine how to split the income from the partnership. And then we'll figure out how each individual partner figures out on their cash flow or pencils out on their cash flow. Oh, the land and buildings. Allie's contributing that. Now, how do we value those land and buildings? Well, it says that Allie has these 40 acres and she's currently renting the land and buildings to a neighbor for $4,000 a year. She has a principal and interest payment of $5,000 a year and pays real estate taxes for $1,000 a year. Well, the easiest way to figure this out is to determine that she is currently renting out the buildings and land for $4,000 a year. So instead of renting it to the neighbor, she's going to rent it to the partnership. Or her contribution, in other words, is $4,000 a year. Yes, I know she has a principal and interest payment of $5,000 a year in the property tax. But if she had the land paid for, she'd have no principal and interest payment. Would that mean that her contribution to the partnership is zero? Of course not. So what we're going to do is value that land at what it would rent out to someone else for. And we already know she's renting it out for $4,000 a year. So that's what we're going to value her contribution to the partnership. The cattle is owned by Sam, and we figured that the cattle depreciate. We have fixed costs in these cattle also. When we figure out his contribution to this partnership or what it cost him to have these cattle every year. Well, they depreciate at 10% a year, and if he sold the cattle, he would invest the money for a 5% return. So that's a 15% fixed cost, which is a real common figure to use. And yes, I realize that he has a principal and interest payment of $6,000 per year on the cattle, but just like Allie with her buildings and land, if he owned the cattle without having any payment towards them, would we figure that his contribution to the partnership was zero? Of course not. So we figure out the annual cost of having these cattle by looking at their depreciation and interest. The depreciation, 10% of 40,000 is 4,000 bucks. 5% of 40,000 is $2,000. Now on to labor and management. Each partner contributes $5,000 apiece. So we add that into the contribution of each partner. So Sam has a contribution of 4,000, 2,000, and 5,000 for a total of 11,000. Allie has a contribution of 4,000 and 5,000 for a total of 9,000. When we figure out each partner's share of the business, Sam's contribution is 11,000 out of 20. That's 55%. Allie's share of the business is 9,000 out of 20,000, or 45%. So at the end of the year, Sam and Allie determined how much money they made from the beef operation. It looks like they had a gross income of $30,000 minus annual production expenses or operating expenses of $12,000 gives a net return between the two of them. So what we do then is take $18,000 times 55% for Sam, that equals 9,900. Do the same thing for Allie, 18,000 times 45%, and that equals $8,100. Yes. So net income for Sam was 9,900. Net income from Allie, 8,100. Now, when we look at the cash flow for each partner, they do have these payments. Sam has the cattle payment, and we say up here that Sam has a principal and interest payment of $6,000 per year on the cattle. Allie has a payment on the buildings for $5,000 a year plus a real estate tax of $1,000 a year. So 9,900 income for Sam minus the $6,000 of cattle payment gives him a net cash flow of $3,900. Allie has $8,100 of income minus the land tax minus her land payment gives her a $2,100 net income or net cash flow. So I hope this makes sense. You'll have a very similar assignment for 8.2. And if, as always, if you have any questions, please feel free to give me a call, drop me an email, or stop by my office, and I'll do what I can to answer any and all of your questions. So thanks a lot and good luck.